you can see the screen, you should be able to see the title sheet here. Type in a yes, please, or a plus. I guess that's fine. Okay, excellent. Okay, so we're going to continue. This is, I believe, the 7th of our webinar series, 7th video or 7th webinar in our webinar series. And we've covered a lot already, and I'm hoping this has so far been useful to those of you that have attended the webinar series so far. We're going to go into much more detail going forward as well, but what we're going to talk about today is sort of taking a bit of a step back and looking at the pros and cons once again between the stock market, particularly the US stock market, and Forex. So what I would like to get out of this webinar, or what I would like you to get out of this webinar today, is to just once again understand the differences between currencies and particularly the US stock market. Now, before we get started, let me also make it clear that while my job here, I was hired by Roboforex to talk about the US stock market and primarily educate you on that and how you can use the Roboforex platform to trade the US stock market. I am not necessarily here to say one market is better than the other. Personally, I'm a stock trader. I have traded currencies, and I do trade a little bit of currencies here and there. So naturally, my market is stocks. So I'm not here to badmouth Forex. I absolutely think there is a place for Forex trading. Certainly, there's a place for Forex in the global world of commerce. Otherwise, we wouldn't be doing any transactions globally if it wasn't for Forex. But just so you know, I just want to, in full disclosure, make sure people understand that I'm not here to talk favorably of stocks versus Forex. I'm just merely pointing out to you that there are various pros and cons in each market. So that's going to be what we talk about today: the distinctive features between stocks and Forex. So the pros and cons, so to speak, is, I guess, one way to look at it. We'll talk about this more in just a minute, but liquidity obviously is a big important part. The stock market is divided up into multiple different parts, but instead of reviewing everything again today, I want to go straight into the analysis that we're going to do today, or sort of the explanation of stocks versus Forex. So like I just said, basically there's, both markets have pros and cons. I don't necessarily think, or I'm certainly not here to make the point of one being better than the other. I do think it's important to understand what the differences are, because there are some very distinct differences that I truly believe that everyone should be aware of if you are trading stocks or currencies for that matter. So in fact, I think both can be traded at the same time. In other words, if you are interested in the stock market, in this case we're talking about the US stock market, you can most certainly, you don't have to stop trading currencies. You absolutely can do those two things at the same time. And when I mean at the same time, I don't mean that you necessarily have to be buying Apple right now and also at the same time buying a euro dollar or whatever other currency pair you might be looking at. What I mean by this is that you don't have to stop trading currencies just because you are now looking to trade a stock or for at least a trade. So I actually think this diversification is very important. And if I will tell you, the very best traders and investors that I know, they actually trade multiple asset classes. So to me, if you are interested in trading stocks and you're already trading currencies, I think that's a very healthy step for you to make, because what you want to learn how to do is to find a specific pattern, mostly that's going to be technical for day traders, or for near-term traders, I should say. I don't want to use the word day trading, but for near-term traders. And so if you can find a specific pattern or a specific setup, whatever it is, you have a much better chance of becoming successful over time if you look for that specific pattern to set up in any asset class, because any given setup is not going to show up in one currency pair every single day, for example. Right? It's not going to happen. It's also never going to take place and show up in every single in any given stock every single day, right? So if you're looking for some sort of a breakout pattern, let's say, right, there's a 0% chance that that breakout pattern is going to take place every single day in, let's say, shares of Apple, or in, say, Eurodollar, or whatever currency you're looking at, right? Does that make sense? Because this is a huge difference, and this probably took me, I don't know, at least 10 years to get to the point where I understood that I need to be looking at the market that way. In fact, if you look at a lot of hedge funds that are good, a lot of the global macro funds and things of that nature, they really focus on a multi asset approach, and a good part of the reason is because they understand that any given setup is not going to occur every single day in that same, not even the same asset class. Okay, so this is really, 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 really important, and something I will repeat over and over again in today's webinar. So I will show you this as well in the charts in just a minute, so you can kind of see what I'm talking about. So let's talk about a bit of the difference of the Forex market overview, and I'm sure if you are a Forex trader, excuse me, you may be aware of some of this already, but it's good. The comparison, I think, is very interesting here. So let's talk about volume. If we talk about volume, it's a little bit difficult to compare sort of oranges to oranges, if you will, because we're gonna have a difficult time comparing the entire Forex market versus the stock market. But essentially, the Forex market is very, very, very liquid if you look at it and you combine all the currencies together. It's about $1 trillion equivalent, roughly speaking, and I don't know how up to date this statistic is right this very minute. But that's roughly your daily volume every single day. Now, that's in terms of, that's a dollar amount. Okay, so I'm not gonna, like I said, I'm not gonna be comparing oranges to oranges, which is a little bit of the difference, but just so you know, there's a ton of liquidity. However, the majority of that liquidity is focused on about 5 different currency pairs, or 5 different currencies. The big one obviously being the dollar, then you've got euro, the yen, the Swiss franc, and the British pound. Of course, there are many other currencies out there, and they are important, but from a volume perspective, this is where the volume is. That's just a historical, that's just a statistic. Okay, it's just a fact. Okay, so what are the market players? Well, the market players are going to be very similar to what we're seeing in stocks. The market players aren't that different in the aggregate. We have banks, other financial institutions like, various intermediaries, insurance companies. There's tons of other players out there in the financial space. Then corporations who need to do currency hedging, right? Mostly, if you think about a large corporation like maybe I don't know, a company you may like Apple, for example, just to name a company you might know. Well, There's a lot of currency adjustments they have to do for sales taking place in different countries and things like that. So central banks, of course, are core to the currency market, for better or for good, and or better or for worse. And some people are saying that individual speculators, day traders in the Forex market, actually make up the majority of the volume. I personally can't tell you whether that's true or not. I honestly don't really know. But if that's true, then that's part of the reason why currencies are so volatile. So let's get a little bit more perspective on this. The blessing, and what many people talk about from a marketing perspective about the currency market, is that it's basically open 24 hours a day. Now, is anyone here trading currencies because it's open 24 hours a day? Is that one? I would love to see some answers if you could. Is anyone in here, is that attractive to you? Is the fact that the currency markets are open 24 hours a day, is that attractive to you? I'm wondering if anyone finds that attractive. Is that good? Do you find that helpful to you? Yes. Okay. So so there's a resounding yes. So we're getting yeses. Now, here's the thing, and this is my personal opinion. Again, I'm not trying to talk badly about the market, but there's a major problem with this, and that is that you do not know. So you have 24 hours in the day. You do not know when your setup is going to be valid. Now, this may not make sense right now just yet, but it's going to hopefully make sense by the time we're done with today's presentation. The currency market is open 24 hours a day, more or less. If you think about the amount of news that can impact any given currency the entire day, it's tremendous, right? It's economic data out of Asia, out of Europe, out of the United States, out of anywhere globally. Now, a lot of people that trade currencies have full-time jobs, part-time jobs. Maybe they're retired, so they come home at night and they look at the currency market at maybe whenever they have time, whenever they want, whenever they feel like that's necessary. The problem is that the currency market is not going to do something of importance just because now you are sitting in front of the computer. Does that make sense? So yes, it's a blessing that you can trade currencies when you have time, but the fact, so that's good, the market is open, but it's not guaranteeing you that whatever you are looking for, whatever specific setup you're looking for, and you should be looking for something specific every single day, is going to take place in that time frame. And it doesn't have to take place every single day, specifically if you're a day trader. But the odds of that occurring in any decent amount of frequency when you're sitting in front of the computer is actually quite low, which is why a lot of currency traders are struggling. Okay, so I'm just trying to give you the pros and the cons of the hours of operation being 24 hours. The marketing people always talk about how that's a good thing. I'm here to tell you that there's also a bad side to that, and I'm hoping this is making sense. Okay, so at the same time, the currency market is also subject to high and sometimes uncontrolled volatility, and that is an issue as well. So it's attractive that the currency markets are volatile, but for a lot of people, when the currency market becomes volatile, it becomes too volatile. And the problem really lies with the last point here, with leverage, right? So your leverage, leverage is a double-edged sword. In other words, it can be really good for you if you make money until a good thing becomes too much a good thing, but it can also be really bad because it doesn't take much for you to almost blow up your account. So leverage really depends on the broker you're using, or the trading platform, if you want to put it differently. And so it's a little bit difficult to talk about leverage, but leverage tends to be very high on average in the Forex market. Now, again, people tend to like that fact, but again, they forget the risk side of it. So what I'm trying to tell you, in the currency market, these are good things to have. 24-hour market opens, absolutely, that's a nice thing to have. High volatility, that's a nice thing to have. High leverage, that's a good thing to have. But if you're going to understand the good side of it, you have to also be aware of what the risk is of that. And the risk is that it's riskier, right? So in my opinion, the currency markets are you can certainly make money in them, but it's fairly risky. Okay? So you always want to make sure you operate with stops and with profit targets. And that for me goes for any market. That also goes for the stock market for sure. Okay, so that's the currency market, a little bit of an overview. Now let's talk about the stock market. And when we talk about the stock market, we have to differentiate, because the stock market, we could bundle the stock market into one big market like I just did the currency market. But with the stock market, it's a little bit silly to do so. So what I'm going to do is I'm going to just kind of talk about the US stock market, particularly here, the New York Stock Exchange. So let me actually make a correction to this, because I did something wrong. This should actually say 3 to 4 billion shares per day. So this is just to give you a little bit of an idea of how, oopsie, that's not what I wanted to do. Let's do done, print it. Okay. So I'm trying to give you a bit of an idea about the difference here. So about 3 to 4 billion shares, and that's just the New York Stock Exchange. This does not include the NASDAQ. This does not include European stocks or Asian stocks or whatever other stock markets there are in the world. This is just the New York Stock Exchange. So the volume traded is very, very high, but of course it's nowhere near as high as what you have in the currency market, because again, we're just comparing one market within the stock market versus the entire currency market. So it's a difficult comparison to make. Now, one thing I said before in the currency market is that there are essentially 5 main currencies, okay, where the volume is. Well, in the stock market, you have many, many more individual stocks, even if they are just large cap stocks, than there are currency pairs out there. What I'm trying to tell you is you have a much better way of playing individual opportunities, if that makes sense. Now, there is a counter argument to this. Like I said, I'm going to give you both the pros and the cons. The great thing about the currency market is that you can diversify very well, because let's say you look at the currency pair of the euro versus the Swiss franc. Well, the euro versus the Swiss franc probably doesn't have a lot to do with the currency pair of, let's say, Aussie dollar versus New Zealand dollar. Okay, so that's a pretty good diversification right there. Those two currency pairs don't have much in common with each other, even though there are much fewer currency pairs out there than there are stocks. So on one hand, the great thing about the stock market is that there are many, many more stocks you can choose from than there are individual currencies. So there are many more opportunities. But here's the problem with the stock market. The stock market, in the aggregate, is very, very highly correlated. So on any given day, let's say the US stock market, let's say the S&P 500, let's say it goes up by 1%, or it goes down 1%, it doesn't matter. Well, when that happens, about 80% of stocks are also going to be going up on that day. In other words, your ability to diversify within the US stock market, or the stock markets in general, is actually quite worse than it is, in my opinion, in the currency market. Okay, I hope this makes sense, because that's a really important point. Now, one way to overcome this problem is to look at the stock market in multiple time frames, and I believe that's one of the topics that we have planned out for another webinar in this webinar series. Okay, so that's an important point. The amount of stocks, there are many more individual stocks you can trade, but they tend to be highly correlated. Whereas with currencies, yes, of course, some currencies are very highly correlated or inversely correlated, right? Which is the opposite, but that's still kind of a correlation, at least by my book. But at the same time, there are some that are completely not correlated. All right. So the market players more or less are the same as far as I'm concerned: banks, financial institutions, corporations, mutual funds, hedge funds, of course. A lot of real money buyers and sellers tend to be active in the stock market. That's maybe one group that I did not add here that I think are a little bit less active in the currency markets. And now we get to the hours of operation, and this is really a big thing. And I talked about this before as being both a pro and a con for the currency market. The fact that the currency market is open 24 hours a day. And we can say the same thing about the US, in this case, the US stock market. If you trade the European stock market, maybe you trade German stocks like the German DAX and UK stocks and all those kind of things. But the issue with the stock market is that it's defined to certain time frames, to certain times. So the US stock market opens at 9:30 in the morning. And I don't know why I wrote EM. That's just supposed to say AM. Anyway, at 9:30 in the morning New York time. So whatever time frame, whatever time that is in your time zone, you can do the math on that. But at 9:30 in the morning New York time, the US stock market opens, and it closes at 4 p.m. on the dot, i.e. exactly at 4 o'clock in New York, right? So you can do the math. That is 6.5 hours of trading that the stock market is open for. 6.5 hours. Now, the problem for some people is that they have, like most people, they have jobs. Maybe they are retired or semi-retired, and they don't want to get to the computer during that time of day. And that causes a problem, right? Because, well, if you can't be in front of the computer at that time, how can you possibly operate in the stock market? Well, I'm a big fan of something called swing trading, which we are going to talk about in one of the future webinars in this webinar series. And I will show you how you can make a lot of money in the stock market and you do not have to be present when the stock market is open. So I'm assuming a lot of you are based outside of the United States, so you have different time zones, right? In fact, some of you might have totally different time zones, where the U.S. stock market is basically only at night, depending on where you live. But you can still make money from the stock market. Like, for example, I have clients that trade with me, that are part of my Clubhouse membership, and they are my students as well. They take my courses, and they live on the other side of the world, like literally opposite the world, like in Australia. And usually the stock market is open when they're sleeping, but I teach them how to make money in the U.S. stock market while they are sleeping. And it's the secrets of swing trading. It has to do with being able to place orders in the market based on the previous day's price action. So these kind of time frames are more like multi-day to sometimes multi-week or multi-month type of time frames, and you can make it's a real sweet spot for the stock market. So in day trading, in the Forex markets, a lot of people are focused on day trading in stocks as well, but in the stock market there's a real advantage, and it's a historical fact that you have an easier time making money looking at the market through a multi-day or multi-week time frame. Okay, so that's that's a little bit of a statistic is here, a statistic that I like to that I really enjoy about the stock market. Leverage, well, leverage in the stock market really depends on your instrument that you trade. If you trade stocks, there's not a whole lot of leverage. Of course, it depends how much leverage your broker gives you. If you trade options, you have more leverage. And if you trade futures on stocks or futures in general, then of course you have even more leverage. So the leverage factor there is maybe a little bit more conservative than what you have in the currency market, but it really depends on which instrument that you trade. But in general, if you trade stocks and just stocks, then the leverage tends to be more conservative than what you have in currency markets, and that tends to be a good thing. Okay, so one last thing I want to talk about here before we maybe look at some charts, and I'd like to take some questions from you, so we can do another round of kind of looking at practical stuff. How do you compare stocks versus Forex? Well, I think the comparison is a little bit silly to do, but I'm going to show you one way that I have found makes a little bit of sense, and it has to do with using something called average true range, or ATR. Average true range is basically, if you want to keep it really simple, it's basically how much a stock or a currency moves in any given day. Okay, so or over over a few days. It depends. Usually it's an average. So I like to use a 14-day, a 2 or 3 week average for the average true range. So I have an idea of how much a stock or a currency moves. So let me show you this, and let's go to the chart. We're going over to the Roboforex platform, and I believe the next webinar on Friday is going to be extensively on how to use the this platform. Okay, so you've seen me operate with it a little bit here over the past few weeks, but I will show you more how to use it, and some basic technical parameters that I think everyone should have as well. Okay, so we are looking at JPMorgan here. This is a stock that I personally have a bit of a short position on this stock right now, in full disclosure, just a small one, which is why I have it open so I can watch it. But let's go. This is a 5-minute chart. This is the price action yesterday, and you can see that the average true range spiked or increased over this time frame. So let's look at the daily time frame to keep it simple. And what you can see here is that the average true range for shares of JPMorgan right now is increasing. And I would always suggest anyone looks at whether it's a stock or a currency, what the average true range is in any specific stock that you might be looking at, or currency over any given time frame. Okay, so the average true range, I think, is an important tool, and it's a tool that I use to give me an understanding of how volatile a market is. A lot of times I'm interested in looking at the average true range for something like the S&P 500 using the SPY. So ABC Trader is saying that 80 average true range is a lagging indicator. It's a lagging indicator, but do you want me to show you how to use it? So the way I use average true range is to, first of all, have an understanding of, if the average true range starts to become really too high, okay, for a given stock or currency, you will tend to see a move in the opposite direction. When the average true range is too low, you will tend to see a direction in the other and move the other direction. So let me show you an example. So here's the S&P 500, okay? And you can see the average true range here. This is 1 year ago, January and February. As the stock market sold off, so too did the volatility. The volatility increased. Okay, so the average true range, as you can see, rose a lot. Okay, now when the average true range, and it depends on your currency or stock that you're looking at. Every stock or currency has a different different levels at which the average true range becomes a lot or too little. But once that happens and you get to extremes, you want to then also look for bullish reversals in the stock itself. Okay, and so I use the average true range as a confirmation tool in addition with price action. I'll give you another example in just a minute. How about this past summer? Okay, so like June, July was very, very, very boring, and into August and even September was a very boring time for the market. Look at that. That's this little box. We actually drew this last Friday when we did the webinar. And you can see the average true range became very, very low, like to the point where it was just crazy. But the stock market slowly started to wake up as we moved into the middle and latter part of September. And even though it still was trading in a range, you can see the average true range picked up a little bit. So I use it as a confirmation tool, if that makes sense. Okay, it's not. I'm not saying you can use that to make a trade, but you can use it in conjunction, right? So like right now, look what happened. We had the news of the presidential election last November, and you can see the average true range expanded. But look what happened since the middle of December, so a little more than 1 month ago, the stock market is very, very much stuck in a range. And it's being shown here on the chart by a lower average true range. So you want to use it as an additional, sort of analysis tool, and not as your main or only analysis tool. Okay, so I hope that makes sense. All right. So now for the rest of this webinar, I would like to maybe start applying a little bit more practical analysis and give you like real-time analysis of what's happening in the market. So I think for the next few webinars that we have, remaining in this series, what we're going to be doing is a format where we will be I'll teach you something like we just did for the past 35 minutes or so. And then we're going to start looking at practical examples. So if you have questions that you want to ask, please ask them. If you have stocks you want to look at specifically, obviously we're focusing on US stocks specifically, so that would be good if you ask about those. So that's basically what we're going to do here. All right. So let me show you a little bit of a setup that I'm looking at right now in JPMorgan, and which is also why currently I have a bit of a short position on. So let me walk you through a real life example for JPMorgan, so you can understand a little bit of what the methodology looks like. So just to summarize, and we'll talk about this more next time, we have the 50-day moving average in yellow, we have the 100-day in blue, and we have the 200-day in red. So what we want to look at here is understand that the rally here was very, very sharp coming out of the election. This is when the US election was won by Donald Trump, and you can see a very, very sharp rally, and then we paused for a little bit, and then we had another rally. Okay, so let me first get rid of this average true range down here, because we don't need it right now. And what I'm going to show you is I'm going to add an oscillator called the MACD, or the Moving Average Convergence Divergence. And the Roboforex platform does a really nice job of highlighting what the MACD looks like. I actually really like this. It's you can see we we have almost like a 3D way of looking at it, just really real nice. So again, another reason why I think it makes sense. So first of all, let's understand what JPMorgan has done. Well, first of all, the move that JPMorgan had out of this consolidation phase, which I actually think, let me see how to do this. I think we just do another one here. Okay, so we're going to make it look like this. So this is kind of how I look at it. We have sort of this consolidation phase, and you can see, so this move higher here was very powerful. And what happened, however, is that the move became too steep, okay, and which is why now we're having a mean reversion move to the downside. So you can see that the MACD base I think it reached like all-time record ever overbought readings. Okay, so JP Morgan got very, very, very overbought over the past few weeks, or specifically coming out of the November election results. Okay, so what's happening now is that the stock is taking a breather. Now here is the key, and this is the way that I like to trade stocks, and it's really working well. And I have courses on this, and I'm happy to talk to you about that kind of stuff in more detail. But let me show you a little bit of what happened. So first of all, let's make this a little bit smaller, and let's forget about the MACD for 1 second. But just keep in mind it was very overbought, and as you can see, the JP Morgan stock really basically just started going sideways for a few weeks after it became extremely overbought. So let's minimize this and let's look at what happened. Okay, so here's what happened. So you can essentially start drawing this consolidation phase in many different ways. I chose to draw it like this, sort of look something like this. And what happened is that this stock reported earnings last Friday, which is from this date is January the 13th. And what happened is the stock reported earnings, and it tried to push past this area of resistance, but it failed to do so. And you can see what happened is on an intraday basis, like last Friday, it tried to rally higher. Let me show you. I'm talking about this here. I'm hoping you can see that. Okay, so let me get rid of that. So you can see that it tried to rally intraday, but this failed, and it didn't drop a lot, but it started to come down on the day and basically closed a little bit higher for the day. But the rally last Friday basically failed. It didn't happen, right? So yesterday, which was the first trading day for U.S. markets for the week, you can see that the stock opened down here. So it gapped down, and we call this a gap. Okay, and what this is telling me is that after earnings, the bulls they really tried hard to push the stock higher, right? But they failed to do so. So the very next day, the stock gapped lower, okay, gapped lower, and actually closed near the very low of the day. So to me, this looks like a failed rally attempt, and well, it doesn't look like it is a failed rally attempt. And now so far today, I'm a little bit short the stock right now. I actually bought some puts, okay, but I actually think this stock probably needs to mean revert lower, maybe into the low 80s, maybe towards whatever 79, 81, something like that. I'm not expecting the stock to completely fall apart, but it's not looking too good right now because of what happened. Now let's do one more thing, and let's look at this stock on a weekly time frame. And what you can see here is very much the same thing. You can see that last week the stock attempted to rally, right, on Friday, but it failed to do so. This is the entire last week. Okay, this candle here is last week, and it couldn't keep it higher, so it still closed a little bit higher for the day, for the week, but not much. And so far this week, and of course today is only the second day of trading for the US stock market, we are following through lower after attempting to rally. Okay. So, to me, this is a very good setup, which is why I took it. And you can see so far the stock is moving a little bit lower on the day. But then again, the entire stock market is not doing anything exciting today. This is the S&P 500 today. Right? This is today, one day. We can look at this in a 5-minute chart, so you have an idea. You can see very boring. Okay, so this is today, just basically going sideways. Okay, although we did have a buy signal here intraday for my B2 reversal indicator. Anyway, so there's a question from ABC Trade. He wants to look at some intraday stuff. So he wants to look at SYMC. Okay, this is Symantec. Basically what we're talking about here is internet security. So the first thing I will do, because we're now in earnings season, is I will look when the stock reports earnings. For all I know, it just reported earnings today. I don't know, so let me have a look. So we'll look, see. Okay, so this company reports earnings on February 1st, and which is to say that it's not really in threat right now. But let's apply a multi-time frame approach, and I'm actually going to make a note because I kind of like this to look at this. So give me 1 second. So from a multi-time frame approach, I know you want to look at it intraday. We'll look at it intraday in 1 minute. All right. But from a long-term perspective, I think we even talked about this last time. I like Symantec here. I really think this is a nice looking chart, but it has still not overcome resistance. So this is very clear resistance that the stock must overcome. What I like is the fact that the stock has been consolidating here. You can see this kind of price movement. We can draw this many ways. We can just draw a box as well. The point is the stock has been consolidating below this resistance zone, right? And now it's pushing higher, and it's trying to push into what used to be resistance back here in 2013 and in 2014. Okay, so that's your multi-year big picture look. Let's look at the daily chart again. Keep in mind the stock is set to report earnings on February 1st. I think I just said. All right, and you can see it now a little bit better. You can see this consolidation phase that took place here, and it's now pushing higher into resistance. Now, this is all very good. My concern would be that this rally here is a little bit too strong in the near term. So, from a MACD perspective, it's not so overbought relative to these overbought level readings here. But then again, these were quite severe overbought readings, so I probably wouldn't assign too much credibility to this move. So let's put this down. And now let's look at the daily chart, the intraday chart. Okay, so let's look at a 5-minute chart, and let's see what happens. Well, from a 5-minute chart perspective, all this stock is doing so far is it's coming back to what used to be resistance. Okay, so let me draw that in. I'm going to take this thing here. Hold on. Okay, doesn't want to work, whatever, it doesn't matter. The point is, what we are seeing here is, excuse me. Let's see here. Okay, what we are seeing is the stock is coming back down to what used to be resistance. All right. So in my opinion, right now, I don't think there's anything to do in the stock. This is an intraday trade, mind you. Okay. I think you had a trade here. When the stock started giving us exhaustion signals up here, you see this is what we call seller exhaustion. All right. And if you guys want to, I have courses on this. I teach this a lot specifically. It's a bit more of an advanced topic, and we can always talk about that. This is actually something, my B2 reversal indicator, as I call it, would have given you a sell signal here. when this took place after this little 5-minute bar. So right now, in my opinion, this stock is just coming back to what used to be resistance. And I don't know what's going to do here. If it gives us a bullish reversal, I would buy it. And if it starts dropping, then we have to go back on the daily chart, which is this one. And then if it gives us a follow-through selling day, so another selling day tomorrow or the day after or something like that, then I think you could sell this for a trade. But again, keep in mind that, in the big picture, the stock looks very constructive, i.e. good, number one. And number two, earnings are coming up on February 1st. Okay, so I hope that's making sense, ABC Trader. Let's have a look at RIA, which is another one that you want. This is Reynolds American. Of course, there's a merger in this stock, so I'm not really sure you want to do a whole lot, but let's again do the multi-time frame analysis, and we're going to do this much more specifically in the specific webinar just on this stuff in a few. I think it's another one or two webinars out. So let me see. This doesn't. Here we go. Okay, now it's working. So let's kind of draw it like this, and I'll show you guys what I mean by doing this. Just give me 1 second. And let's do it like this. All right. So this to me is sort of your long-term uptrend in the stock. Okay. And when I say long, this is a long-term uptrend. So let's zoom in a little bit closer. And you can see that the stock rallied out of resistance. Let me have a quick look at something here on the from a news flow perspective. Give me 1 minute. Alrighty. Okay. Yeah, I think this company bought. Let's see. Yeah, British American Tobacco basically purchased, I believe, the rest of the shares of Reynolds American. So this is a merger story, and so in my opinion, this is probably not something that you want to be too involved in on an intraday basis, just from a news flow perspective. So yeah. Basically, British American Tobacco offered $47 billion for the rest of Reynolds. They already own parts of it. So in my opinion, I probably wouldn't go in and trade the stock based on that. And I'm just saying because there's too much news flow right now in the stock. Okay, does that make sense? This is everyone will have their own rhythm, but I think there's much better trades out there. Like for example, and this brings up a good point. So like yesterday, for example, I just mentioned this trade idea in JPMorgan that I'm focusing on right now. So a lot of times there isn't a whole lot of stuff to trade. So like really yesterday and today so far, it's really just the financial stocks that are interesting, at least in my personal opinion. So if we now look at the 5-minute chart real quick, just to give you a bit of an idea of what this looks like intraday, let me zoom out. You can see, you can apply this technical analysis on any time frame. So look at this, for example. This is the 100 period moving average. So this blue line, and you can see that 100 period has not really been of any significance over the past few weeks because the stock itself just went sideways. But look at this, it now rallied up to that and gave us a bearish reversal. Okay, so like my B2 indicator would have given you a bearish reversal on that as well to basically short the stock or sell it again. So again, this is just what I'm doing is I'm giving you a little bit of a preview to the next webinar, or I think it's going to be the webinar in a couple webinars from now on multi-time frame analysis. So, but you can see this short trade is working pretty good. I'm still short. I'm actually long some puts. So let's see if I'll have to see if the stock can get towards 80 or whatever, something like that, dollars a share. So that's one thing I'm looking at right now. Let me get back to the daily time frame. And also, you know, if you're looking at a big name stock like this, you also want to look at some stocks that reported earnings today. So for example, this is Citigroup. Let's look at Citigroup and see what Citigroup is doing today. You can see Citigroup is down, okay, quite significantly. How about Goldman Sachs? Also reported earnings today. You can see Goldman Sachs too is reversing lower, okay. How about the entire financial sector ETF, exchange traded fund? You can see also lower. Also, one of the stocks seems to be okay. Look at Bank of America, holding the line. So Bank of America is outperforming. How about Wells Fargo? It's another big name bank. That one is slipping, but still within this bull channel. But nonetheless, it's slipping. You know what we're looking at in a name like this is probably this area of support on a daily closing basis, like this. You can see we're dropping below. So I think this JPMorgan stock here is looking pretty good on the downside. And you know, interesting. Like if you go back to, let's look at Citigroup for a minute, and let's look at it on a intraday basis, like a 5-minute chart, like today. You can see. So this is today. This price action here. This starting with the volume spike at when the U.S. stock market opened. And you can see the first reaction for the first, you know, half hour or so was that yes, the stock opened a little lower, but then it quickly was bought, and it came into that 50-period moving average. That's the yellow line, bearish reversal, and now it's starting to drip lower, and it's at the lows of the day right now. Okay, and for JPMorgan, and this company actually reported earnings today before the market opened. So you can see that the news is getting sold. Let's look at what JPMorgan looks like on sort of a moving, yeah, same. So this we just looked at this before. You can see found resistance at the 100-period moving average, and now it's going lower. Okay. Okay. Are there any last questions, or are we good? What we're going to do on Friday is we're going to talk about the Roboforex platform, and we will show you how to use it for your stock trading. We will show you some tricks and tips and general stuff, and some more technical analysis tips and tricks. And I will show you some real-time live analysis as well. So hope you guys will join me. And I want to thank you for attending today. And I wish you a good rest of your day.